If you're looking to expand your investment portfolio, exchange-traded funds, or ETFs, could be the perfect addition. ETFs are collections of stocks, bonds, or commodities offering a diverse and flexible way to invest your money. By investing $10,000 in each of the top 5 Investco ETFs, you're diversifying your portfolio and potentially increasing your chances of positive returns. With ETFs, you're not putting all your eggs in one basket. You're spreading out your investment across different industries, sectors, and even countries. Investing in ETFs can offer potential growth opportunities, but as with any investment, there are always risks involved. Diversification can help mitigate some risks, but ETFs are still tied to market fluctuations and changes in the economy. It's important to consider your own risk tolerance and financial goals when deciding whether ETFs are right for you. But what would your returns actually look like? We're about to find out. Understanding ETFs. Exchange-traded funds, or ETFs, are investment vehicles that hold a collection of assets, such as stocks, bonds, commodities, or a mix of these. They trade on stock exchanges like individual stocks, which means investors can buy and sell them throughout the day. This makes ETFs more flexible and liquid compared to mutual funds, which are priced only once a day. ETFs can be passively managed, meaning they track a specific index or sector, or actively managed, meaning they are managed by a team of professionals who select the assets in the fund. Some of the benefits of ETFs include diversification. ETFs hold a variety of assets, such as stocks, bonds, or commodities, which can help investors diversify their portfolios and reduce risk. By investing in ETFs, investors can gain exposure to a broad range of assets without having to purchase individual stocks or bonds. Lower costs. ETFs typically have lower fees than actively managed funds, such as mutual funds, which means investors can keep more of their returns. Additionally, ETFs can be bought and sold like stocks, which means investors don't have to pay load fees or redemption fees. Flexibility. ETFs trade on stock exchanges, which means investors can buy and sell them throughout the day. This provides investors with greater flexibility to adjust their portfolios in response to market conditions or changes in their investment goals. Invesco ETFs are a popular choice among investors due to their reputation for delivering strong performance and low fees. Invesco is a well-established asset management company with a long history of providing investment products that cater to a wide range of investor needs. The company has a wide range of ETFs that cover various sectors, industries, and geographic regions, making it easy for investors to find an ETF that aligns with their investment goals and risk tolerance. Overall, Invesco ETFs have a strong reputation in the market for their performance, low fees, and diversification benefits. Overview of the top 5 Invesco ETFs. Number 5. Invesco QQQ Trust, ticker QQQ. The Invesco QQQ Trust is an ETF that tracks the performance of the NASDAQ 100 index. This index includes some of the largest and most innovative companies across various sectors, such as technology, healthcare, and consumer goods. By investing in QQQ, investors gain access to a diversified portfolio of large-cap growth stocks, including well-known names like Apple, Microsoft, and Amazon. As one of the most heavily traded ETFs in the U.S., QQQ offers investors high liquidity, making it easy to buy and sell shares in the fund. The QQQ ETF has historically outperformed the broader market, providing investors with the potential for strong long-term returns. However, it's important to note that past performance is not a guarantee of future results. Investors looking for exposure to some of the world's most innovative companies through a single ETF would find the Invesco QQQ Trust an attractive investment option. Number 4. Invesco S&P 500 Equal Weight ETF, ticker RSP. The Invesco S&P 500 Equal Weight is a unique investment option that offers exposure to the S&P 500 index with an equal weighting approach. Unlike market cap weighted ETFs, RSP allocates equal amounts of money to each stock in the index, resulting in a portfolio that leans more towards mid-cap stocks. This approach reduces concentration risk associated with overexposure to the largest U.S. companies and provides investors with diversification benefits. RSP is rebalanced quarterly to maintain equal weighting, ensuring that the portfolio remains well diversified. This ETF is an interesting option for investors seeking exposure to the S&P 500 index while mitigating concentration risk. However, it's important to note that this approach would also reduce exposure to some of the largest and most influential companies in the index. Number 3. Invesco NASDAQ Next Gen 100 ETF, ticker QQQJ. The Invesco NASDAQ Next Gen 100 is an investment option that tracks the NASDAQ Next Generation 100 index. This index focuses on mid-cap companies listed on the NASDAQ exchange, providing investors with exposure to upcoming companies with high growth potential. The QQQJ ETF offers investors the opportunity to capitalize on the growth and innovation of emerging companies without having to individually select and invest in each stock. By investing in QQQJ, investors gain diversified exposure to a wide range of industries and sectors within the NASDAQ exchange. However, it's also important to note that investing in mid-cap companies may come with higher risks and volatility compared to larger, more established companies. Therefore, you should carefully consider your risk tolerance and investment goals before investing in the Invesco NASDAQ Next Gen 100 ETF. Number 2. Invesco S&P Small Cap 600 Pure Value ETF, ticker RZV. The Invesco S&P Small Cap 600 Pure Value ETF is an investment option that seeks to track the performance of the S&P Small Cap 600 Pure Value Index. This index focuses on small-cap companies that exhibit strong value characteristics such as low price-to-book ratios or high dividend yields. The RZV ETF invests at least 90% of its total assets in securities that make up the underlying index. By investing in this fund, investors can gain exposure to a diversified portfolio of small-cap companies with attractive value characteristics. Keep in mind that investing in small-cap companies can come with higher risks and volatility compared to larger, more established companies. Therefore, investors should consider their risk tolerance and investment objectives before investing in the Invesco S&P Small Cap 600 Pure Value ETF. Number 1. Invesco Bullet Shares 2025 Corporate Bond ETF, ticker BSCP. The Invesco Bullet Shares 2025 Corporate Bond ETF is designed to provide exposure to a diversified portfolio of investment-grade corporate bonds that are set to mature in 2025. This ETF aims to offer investors a way to manage interest rate risk while providing income through bond investment. BSCP primarily invests in bonds that mature in 2025, which helps to reduce interest rate risk compared to longer duration bonds. The ETF focuses on investment-grade corporate bonds, which are considered to have a lower risk of default compared to lower-rated bonds. Investors can expect regular income distributions from the interest payments of the underlying bonds, making it an attractive option for income-seeking investors. The performance of BSCP is influenced by various factors, including interest rates, credit spreads, and the overall economic environment. The ETF strategy is to hold bonds until maturity, which can help mitigate the impact of market volatility on the portfolio's value. Investment breakdown. To allocate a $50,000 investment evenly among the 5 selected ETFs, you would divide the total investment by the number of ETFs. So you would invest $10,000 in each of the ETFs. Please note that the allocation and performance of these ETFs can vary over time, so it's important to monitor your portfolio and make adjustments as needed to ensure it aligns with your investment goals and risk tolerance. Balancing investments is crucial in portfolio management as it helps mitigate risk and enhance long-term performance. By diversifying your investment across various assets, industries, and geographies, you avoid overexposure to a particular sector or company, thereby reducing the impact of volatility on your portfolio. In this case, the selected ETFs provide exposure to a range of market capitalizations, sectors, and investment strategies, which can help manage risk and potentially smooth out returns. The allocation to a corporate bond ETF also adds a fixed income component to the portfolio, which can provide stability and income. Ultimately, the goal of balancing investments is to generate consistent returns while managing risk. A well-diversified portfolio should contain assets with varying levels of risk and correlation, allowing investors to strike a balance between risk and return that aligns with their investment objectives. Exchange-traded funds generally have lower fees compared to actively managed funds like mutual funds, but there are still some costs associated with investing in ETFs that investors should be aware of. Expense ratio is the most common fee associated with ETFs, and it covers the cost of managing and operating the fund. Expense ratios are expressed as a percentage of the fund's assets under management and are deducted from the fund's returns. When buying or selling ETFs, investors may need to pay a trading commission to their broker. Some brokers offer commission-free trading on certain ETFs, but it's essential to understand the fees associated with trading before investing. The bid-ask spread is the difference between the highest price a buyer is willing to pay for an ETF, bid price, and the lowest price a seller is willing to accept, ask price. This spread is not a direct fee, but it can affect an investor's overall return. Some ETFs charge additional management fees to cover the cost of managing the fund's underlying assets. These fees are often incorporated into the expense ratio but should be considered when evaluating the overall cost of investing in an ETF. Understanding the potential fees associated with ETF investments is crucial to ensure that they align with your investment goals and budget. It's also important to remember that fees can significantly impact your investment's long-term performance, so it's wise to compare the cost of different ETFs and select those with lower expense ratios and fees. Potential returns. Over shorter time frames like a year, the performance of these ETFs can be influenced by market volatility and economic cycles, making returns less predictable. Over a 5-year horizon, the ETFs focused on growth stocks QQQ, QQQJ may potentially generate higher returns than broader market and fixed income ETFs, but they also carry higher risk. Over a longer time frame, all of these ETFs have the potential to deliver positive returns, given their diversified nature and historical performance. Small cap value stocks may outperform over the long term, while the fixed income ETF could provide stability and income. Remember that historical performance is not a guarantee of future results. It is important to carefully assess your investment objectives, risk tolerance, and time horizon before investing in any ETF. That's all for this video. If you found our review informative and helpful, please take a moment to like this video and share it with friends, family, or anyone who might be interested in investing. Also, don't forget to subscribe to our channel for more valuable investment insights and in-depth analysis on various financial topics. If you don't want to miss a beat, kindly turn on notifications for all our videos and you will be the first to know when we share a new update. Thanks for watching.